All right, let's jump right into this explainer. Today, we're doing a deep dive into some fresh equity research to figure out why Wall Street might be completely mispricing an absolute cash flow machine.
To really get Post Holdings, you've got to realize they are way more than just a cereal company. I mean, sure, when you hear Post, you probably think of Fruity Pebbles or Honey Bunches of Oats, right? But their actual footprint is massive. They own Michael Foods, which pretty much dominates commercial eggs and potatoes in the food service world. They've got Bob Evans in the refrigerated aisle, the giant Weetabix brand over in the UK, and they recently made this really aggressive push into pet food with Nutrish and 9 Lives. Plus, there's 8th Avenue, their huge private label business. So the main takeaway here is that Post doesn't really act like a legacy food brand. They operate a lot more like a highly aggressive private equity firm that just happens to buy packaged food assets. They buy steady, cash-flowing businesses, optimize the heck out of them, and then use that cash to either buy more companies or aggressively shrink their own share count.
And that brings us to the dramatic post-earnings shock we saw back on August 7th. The stock took a brutal hit after hours, dropping just over 10% to $81.10. Now, for a defensive consumer packaged goods stock, a double-digit drop in a single day is a violent repricing. I mean, the market basically slammed the panic button. But to figure out if this was actually a justified sell-off or just Wall Street totally overreacting, we need to pop the hood and look at what's really going on in those Q3 numbers. Okay, when we peel back the layers of this Q3 earnings report, there's a really stark contrast. The bearish headline, the part that spooked people, is that revenue came in at about $1.95 billion. That's down almost 2% year over year, missing street estimates by 4.4%. Net income also took a massive hit, dropping from over $108 million all the way down to $63.4 million. Yikes, right? But here is the wild part. Despite all of that, their adjusted earnings per share actually beat consensus, coming in at $1.78. So how on earth does a company miss on revenue, see their net income plummet, but still manage to beat EPS estimates? Keep that question in the back of your mind because the answer is literally the core of the bull thesis we're going to unpack in a minute.
Actually, the real trigger for that massive sell-off wasn't even the current quarter. It was management spooking everyone with a forecast of completely flat organic growth for the upcoming year. You know how Wall Street is. They hate uncertainty, but if there's one thing they absolutely despise, it's zero growth. Management maintained their current year guidance, sure, but then they explicitly forecasted that adjusted EBITDA for FY2027 would just sit flat at roughly $1.48 billion. The market took one look at that and immediately priced Post as a stagnant company that just can't grow its sales organically anymore.
And this slide brilliantly illustrates their private equity-style balance sheet. They're operating comfortably in the mid-4x net leverage range, which inherently amplifies both the risk and the reward for equity holders. Look at this. You've got a market cap of just $3.67 billion sitting directly underneath a towering debt load of $7.63 billion. For a traditional investor, that ratio looks like a glaring red flag. But honestly, this is exactly how Post is engineered to run. They use leverage to acquire food assets, run super efficient working capital cycles, and then use the cash to service the debt and reward shareholders. While their debt maturities are laddered pretty safely into the future, this highly leveraged structure means that any slowdown in organic growth, like that flat guidance we just mentioned, makes the market incredibly nervous about their ability to handle that debt in a higher-for-longer interest rate environment.
Of course, the bearish narrative isn't just about the debt. It centers heavily on some very real macroeconomic headwinds. First off, their gross margins have squeezed down to 29.1%, which points to a loss of pricing power as inflation normalizes. But the bigger, sort of existential fear hanging over the whole packaged food sector right now is the rise of GLP-1 weight loss drugs. The market is absolutely terrified that these drugs will permanently shrink calorie consumption, which is a direct threat to Post's legacy sugar-heavy cereal brands. Add to that the fact that their massive Michael Foods egg business regularly gets disrupted by agricultural shocks, specifically avian influenza, plus wild volatility in freight and fuel costs. So, yeah, this is the wall of worry that ultimately triggered that 10% sell-off. But guys, here is the absolute game changer. Despite the flat top-line growth and all of those industry headwinds we just listed, Post is an absolute cash machine. They are generating a massive 14% free cash flow yield. This one single number flips the entire script. Even with revenue stagnating and margins getting squeezed, the underlying business is throwing off an unbelievable amount of raw cash relative to its market cap. I mean, a 14% free cash flow yield, that's incredibly rare, especially for a mature consumer goods company. It provides this incredible safety net and gives management so much optionality. And when you benchmark Post against industry titans like General Mills or Calavana,
You see it trading at a severely depressed 7.7 times enterprise value to EBITDA multiple. That screams extreme pessimism. Historically, Post averages an EV to EBITDA multiple closer to 11.8, but right now, just 7.7. Meanwhile, its peers are sitting anywhere from 9.5 to 12 times. Looking at the forward PE, Post is under 12, while the rest of the industry averages around 15 to 22. And just look at that free cash flow yield at the bottom again, 14% for Post compared to a peer average of maybe 6 to 8%. Wall Street is currently pricing this stock as if it's in terminal decline, putting it at a massive, massive discount.
But here is where we see their financial engineering masterclass in full effect. Management took that massive free cash flow we were just talking about and ruthlessly retired 17% of all outstanding shares in just 9 months. Let that sink in for a second. In under a year, they bought back and literally erased almost 1/5 of the entire company. This perfectly answers that question we asked earlier. How do you miss on revenue, take a hit on net income, but still manage to beat EPS? You do it by artificially forcing EPS growth. You just radically shrink the denominator, the share count. This is exactly why top-line stagnation is not a death sentence for Post. As long as they're generating this much cash, they can just keep shrinking the float and driving tremendous value to the remaining shareholders.
Now, this isn't just some paper trick. They actually have very stable operational anchors building a solid foundation for the future. Take their food service segment. It's successfully normalized to a really healthy $500 million annual run rate, finally leaving behind all that volatility from the avian flu pricing spikes. But more importantly, they have massive margin expansion potential if they can just successfully turn around those newly acquired Smucker pet brands. Management noted that their 30% market share in the pet space is stabilizing as they relaunch Nutrish and 9Lives. If they can flip that segment from a margin drag into a cash contributor, that is a huge catalyst. Finally, you've got 8th Avenue. As consumers feel the pinch of inflation and start trading down from premium brands, this private label business is perfectly positioned to intercept all that demand.
So what does this all mean? Ultimately, the market is looking at this and seeing a stagnant value trap, while the contrarian base case sees a highly defensive cash harvesting engine. It really boils down to which narrative you buy into. The bear case says that flat retail volumes and high freight costs are going to squeeze margins so tight that this $7.6 billion debt load will just suffocate their free cash flow, ultimately forcing management to stop those buybacks. And if that happens, the multiple shrinks even more. But the base case, the contrarian play we're looking at here, argues that you really don't need top-line fireworks. You just need that 14% free cash flow and a management team that is absolutely dedicated to relentless share reductions. Mathematically, that combination alone generates a low double-digit compound annual growth rate for EPS.
If we look at the technical damage from the sell-off, the stock is definitely flashing some bearish structural signals, having forcefully broken below both the 50-day and 200-day moving averages. However, check out this deeply oversold RSI reading. It dropped way under 30. That sets up prime conditions for either a sharp dead cat bounce or the start of a long-term base-building phase. When an RSI dips this low on a highly defensive, cash-generating staple stock, it's usually a pretty strong signal that the institutional panic selling has finally exhausted itself, which paves the way for value buyers to start stepping in.
For value-oriented investors, the dominant shareholding force right now is actually the company itself. That puts a massive floor under the stock, making the $78 to $81.50 zone a super compelling area for dollar cost averaging. Look, this is not a stock you buy expecting immediate parabolic growth. It's an accumulation play. By repurchasing 4% of their shares in Q3 alone, management is loudly signaling exactly where they believe fair value sits. Historically, their willingness to aggressively buy back stock at the $85 to $95 level tells us their internal models value the company comfortably above $100. So as a retail investor, being able to accumulate shares around the 52-week low of $79, right alongside a management team that's aggressively buying their own dip, that offers an incredibly wide margin of safety.
Let's put a number on it. Assuming literally 0% organic growth and just a simple continuation of these aggressive buybacks where they retire maybe 8 to 10% of the float annually, the base case discounted cash flow fair value sits right at $105 per share. That target offers a very attractive 25% upside over the next 12 to 18 months. And remember, that valuation completely writes off any massive fundamental turnaround. It just assumes they keep doing exactly what they are doing today. If the pet food segment actually returns to solid growth, or if those food service margins expand, well, that $105 target suddenly becomes highly conservative.
So as the dust finally settles on this Wall Street overreaction, you really have to ask yourself, are you willing to bet against a management team that is mathematically engineering their own success? Yeah, the debt is heavy for sure, and obviously the cereal aisle isn't exactly the next big tech frontier.
But when a company is generating this much raw cash and then weaponizing it to shrink their outstanding share count by nearly 20% a year, the fundamental laws of math dictate that earnings per share are eventually going to march higher. It is truly a masterclass in capital allocation, just hiding in plain sight behind a boring cereal box. What do you think? Are you going to keep viewing Post as a stagnant value trap, or realize it might just be the most defensive cash machine on the market right now?